Hello everyone and welcome back. Today we will be discussing the secrets behind the Asian range, specifically the Asian range kill zone. This lecture in itself will help you guys determine bias and predict price to the exact pip, or for those of you trading futures, tick. Nobody is really explaining anything to do with the Asian range except for ICT and Romeo himself. There's a reason why nobody truly wants to expand deeper into it. It's because it works. Without wasting your time, let's just get straight into this lecture. There's three main parts. Let's take this down into your notes. We're going to have a what is the Asia range? Basically, what exactly is the Asian range? Next up, we have the Asian range model. So of course, in this lecture, there will be a model that will be taught. Very, very, very high probability. And number three, how to actually use the Asian range to determine your bias. So, what exactly is the Asian range? It's specifically the kill zone, opening kill zone of the Asian range. The Asia range begins at 8 p.m. New York Eastern Standard Time. This would be UTC -4. I want to make this clear before moving forward. If you guys are trading any asset, please put your charts to UTC -4 and do not change it ever. You should not be trading on any other time zone other than UTC -4. This will help you guys a lot in the future. So let's get back to it. The Asia range begins at 8 p.m. and ends at midnight. On the 24-hour clock, this would be 20 o'clock to 00. This time period marks the opening hours of the Asian markets. As you can see right here, price will typically consolidate, specifically during this time period of 8 p.m. to midnight. Almost every single day, you will see a consolidation phase between 8 p.m. and midnight. As I have taught in the past lectures, and Romeo really tries to drill this into your heads if you listen to him. After consolidation comes expansion. Write that down in your notes. We do not consolidate and consolidate and consolidate. No, we consolidate, expand, consolidate, retrace, expand. Write that down. Of course, there's another sequence. Consolidate, expand, retracement, fail to expand higher, reversal. The Asia range is characterized by low trading volumes and narrow price movements. This is basically a more complicated way of saying consolidation. Right? Consolidation just means price will move sideways. We're going to create buy-side liquidity and sell-side liquidity down below. Very basic stuff. So now, why exactly is this specific range important? Understanding the Asia range is crucial for traders as it often sets the stage for price movements in subsequent sessions. What does this mean? This means that the Asia range will basically set you up as soon as you understand how the Asia range works. You will basically understand what will happen in the London session and what will occur in the New York session. This goes back to the first introduction slide where I said you can determine where price will end on the day to the tick, or pip for you Forex traders. Recognizing consolidation patterns during this time can provide valuable insights for predicting breakouts or reversals, specifically when the European, also known as London markets, open. So here is a 15-minute chart. As you can see, from 20 o'clock to midnight, so 8 p.m. to midnight is the Asia range. We saw expansion, right? Coming into the Asia range. This is not really consolidation. However, we did create our sell side and we did create our buy side. I just want to make this clear. Price will not always move specifically sideways during the Asia session. There is just a high chance that it will. Regardless, you can still use it. London session open from 1 a.m. to 5 a.m. Of course, this is not the entire London session, as the London close carries on into the New York open. However, this is the London kill zone from 1 a.m. to 5 a.m. I have a London session model that was explained in the previous lecture. Please check that out if you haven't already. So we sweep Asia range highs, break back into the Asia range, and where will we go? Likely the opposing end of the Asia range low, and then a final destination. So here are the foundations of the Asia range and its model. When analyzing the Asian range, traders should identify the highest and lowest price points within the period. So as you can see here, you want to draw out the high and low of the Asian range. To help you do this, please draw a vertical line at 8 p.m., 20 o'clock, and another vertical line at midnight. Between these two time periods, you want to draw the low and the high. In the previous example, we did the same thing, the low and the high. These levels are important because they define the upper and lower boundaries of the consolidation, of the range. By extending these high and low levels horizontally to the right side of your chart, traders can create a visual representation of this range. Do not just guess where the Asian range is. Draw out the high, draw out the low, and extend the lines into the next few sessions. So I hinted at this on my Twitter account. Price ranges versus timed range. There's two different ranges in the markets. One is a price range and the other is a timed range. There's a big difference between the two. The Asia range, for example, is a timed range. As we can see, from 8 p.m. to midnight. This is a timed range. You want to find the low and the high of this specific timed range. This method helps in distinguishing price between price ranges and timed ranges. While price ranges focus on the levels where price fluctuates, a timed range, like the Asia range, as I mentioned right before, emphasizes the specific time period which the price action actually occurs. So I just want to give an example of a price range, not to confuse anybody. A price range would be a dealing range. So from any swing high to any swing low would be considered a price range. As you guys know, a CRT range, so a 4-hour candle high and low, is a timed range. Why? Because you are trading based off of the high and low that formed within a 4-hour timed range. Very simple. By extending the high and low of the Asian range, traders can maintain a clear view of the consolidation as the market progresses into the subsequent trading sessions, so specifically the London Open Kill Zone. This is directly from Lumi Trades. It is absolutely correct. These are all timed ranges, right? So we got the London Open Kill Zone, the New York AM session, we have the London close, we have New York lunch, we have the CBDR, central bank dealing range, and the Asian kill zone. So here are two examples, one being a price range and the example on the right being a timed range. First example is a dealing range, not the central bank dealing range, just a random dealing range. No specific time, simply a swing high to a swing low. This is a dealing range. This is a price range. You are looking at liquidity from the swing high, buy side, and liquidity at the swing low, sell side. Why is this a swing low? Why is this a swing high? We got a lower candlestick, lower high to the left and lower high to the right, swing high. Same thing here, higher low to the left and higher low to the right, swing low. This is a timed range from 8 p.m. to midnight. This is the Asian range. As you can see, we're consolidating, creating sell side liquidity, coming back up, creating buy side liquidity. We're basically staying in a zone. This is a timed range, time specific. What specific times? From 8 p.m. to midnight. So let's take a look at another example. Those of you who know this example know exactly where it comes from. There is a reason why I am using this image. Now, this is the Asian range. This is the London range. Study what happens. Study. We create buy side and sell side, high and low of the Asian range. As soon as the Asian range closes, we expand above the Asian range and we are displacing back below. You want to look for your entries. Turtle soup, order block formed, entry off of the order block. If you don't catch it, you can catch an OTE. This right here is the basis of the Asian range model. Study this very image. Let's talk about some specifics. In the previous example, we can clearly see the market structure. Structure was bullish during the Asian range. Lows are being rejected and highs are being broken. Explained from the previous lectures, we know that when lows are being rejected and highs are being broken, this is bullish. Whereas when highs are being rejected and lows are being broken, that is bearish. Let's take a look at this example one more time. Rejecting a low, breaking a high. Rejecting a low, breaking through a high. Rejecting a low, breaking through a high. Bullish. This is bullish market structure. Let's get more specific. The lows which initially helped break the previous highs are being rejected. This rejection indicates strong bullish sentiment, as it basically shows that market participants are not allowing the price to fall below these critical points. We can see that the high that rejected the low was violated, also known as broken. This is the market structure shift. Right here. As you can see, we started breaking highs over here, created a low, tried breaking through the low, rejected the low, and broke through the high market structure shift. Came back below. We will not cross this low. Why? Because this is the swing low that caused the market structure shift. Very important to understand. After the high is broken, price retraces back into the previous range before resuming its upward movement. This behavior is typical in a bullish trend. This is called the retracement, right? Remember when I talked about consolidation, expansion, retracement, expansion. This is the retracement. What comes after is expansion. So this behavior is typical in a bullish trend where the market consolidates momentarily before continuing to rise. Consolidates also meaning retraces. So what does that mean? We reject a low, expand past a high, break the high, close above it, retrace back down, expand higher. Same thing right here. Break a high, reject a low, break a high, retrace back down. We shall not cross this low. Why? Because this was the low that rejected a low and broke a high. The low that broke the high shall not be passed or hit or tapped, whatever you want to say. The low that broke the high in a bullish market shall not be reached. We will expand, retrace, and expand. Right? Consolidation, expansion, retracement, expansion. That is the sequence that I have been mentioning in the previous lectures. Do you guys see how everything from lecture to lecture, everything goes together? Nothing contradicts anything. When you are learning from mentors, even though I have stated exactly what Romeo has stated, choose between 1 and 2 mentors at max. You guys will probably not listen. I hope you do, but if you don't, make sure you are listening to the right people. Make sure what they teach does not contradict anything. Anything. This means if they are saying one thing in a specific lecture and in another lecture they are teaching another model that contradicts the first model, do not listen to them. Everything I am teaching goes together perfectly, like a puzzle. I am giving you puzzle pieces by the week. It is your opportunity to put the puzzle together. Some more thoughts. In the example from before, the Asian range passed 12 o'clock. The price continued to rise, creating a high, then a low, followed by a higher high. Right? So we create the high, reject a low, and break through the previous high. And this is the higher high. The downtrend began when the price broke through the low that initially broke the high. Let's take a look. The low that broke the high was broken. That never happened anywhere here. That is why we were bullish. That is why structure was bullish. Because we did not break through a low that rejected a high. Over here we did. This is after the London Asian session. During the London session, we break through a high, reject a low, break through a high, and break through the low that rejected the high or broke the high. This is the bearish market structure shift. As you can see, retrace back down. Turtle soup. Coming coming back down. Understanding this sequence right here is very important towards your success. Why are we not entering here, but why would we enter here? If you haven't watched my last video, your highest probability entries in the London session will come between the times of 3 a.m. to 5 a.m. This is known as the London Twilight Zone. 3 a.m. would begin right around here, and 5 a.m. would end right around here. This is not an entry. The best entry on the example above would be using the 3 candle model at the highest point of the range. So you want to go onto a higher time frame, look for a CRT above right here. So this would have been a candle, wick above, order block formed, entry off the order block, short targeting where? The midpoint of the Asian range and the low of the Asian range. Write that down. Traditionally, the highs that broke the lows and the lows that broke the highs are used to determine the bias. There's a reason why that is in bold. This means that from the moment we close below the low that broke the high, we expect the market to retrace and target previous lows, such as the Asian range low. After this retracement, the market is likely to expand further downwards, targeting even lower levels. Looking at this example, let's use the exact rules that I spoke about in the previous slide, and let's apply them to this example. Asian range, high and low. Breaking through the Asia range high. High formed, low formed, rejecting a high, breaking the low that rejected a high. Important. This is the change in state of delivery. There's an order block between here. That is why this is the change in state of delivery. Entry off of the fair value gap for those of you who trade it. Coming back down to the Asian range low, retracement. We got an expansion, retracement, expansion. This could have been your entry on a higher time frame. This is a 3 candle model. Write that down. There's a reason why this says turtle soup. Because this is a 3 candle model. 1, 2, 3. Study this. 3 candles where? I don't see 3 candles anywhere. 3 candles on a higher time frame. We are turtle souping the Asia range high. Order block formed. Retrace back into the order block, targeting the Asia range lows and lower. This is the model. Study it. So let's take a look at a step-by-step example. As I mentioned before, the timed range is between 8 p.m. and midnight. Draw the high and low. Extend them to the right of your chart. This is step 1. Now, wait for one side to be taken. One side of the Asia range taken. How do we know? Displacement back below. Breaking a low that rejected a high. This is also known as a liquidity sweep or a turtle soup or whatever you want to call it. It does not matter. We wait for price to break through the range high or low and then wait for price to break back into the range. Focus on locating the change in state of delivery. In the example above, the one that we just looked at, we swept the Asia range highs and targeted the Asia range lows. As you can see, sweeping the Asia range highs, targeting the Asia range lows. After the liquidity sweep, look for a market structure shift to confirm a change in direction. If the market structure shift occurs, then you can aim for the low of the Asia range as your target. Market structure shift, entry short. If you missed it, higher time frame, market structure shift, entry short, targeting the low. Now, I'm sure a lot of you guys have been waiting for this specific slide. Use the Fibonacci retracement tool and extend from the high and low of the Asian range. Add the standard deviations. How do we know where the Asia range will stop? Other than using key levels, there is another tool that can be used that, in my eyes, works like magic. Use the fib, as I mentioned, extend it from the high and low. So you would extend it from the high to low. Standard deviation, rejection, turtle soup. After midnight, price will usually target the first or second standard deviation of the Asian range. Your goal is to catch the reversals at one of the standard deviations by focusing on the change in state of delivery. Before a change in state of delivery, there will always be a turtle soup. Write that down. You will then target the equilibrium of the Asian range and then the low. You can also leave runners going into the New York open session, as price will usually retrace up, forming an optimal trade entry, specifically during the open of the New York, and then continue the downtrend, targeting a standard deviation of the Asian range itself. This is the Asian range, high and low. As you can see, 20 o'clock to midnight. High and low, Fibonacci retracement, first standard deviation, second standard deviation, first standard deviation, second standard deviation. What is the rule? Price will usually end up at a standard deviation below. So first or second standard deviation below or above, and then target the opposing standard deviations. Turtle soup, where specifically at the second standard deviation below the Asian range. Magic. Where do we go? Up. Change in state of delivery. Order block formed. Order block never hit. Why? Breaker. As soon as we close above the breaker, we hit the breaker. Entry long. Targeting where? The high of the Asia range, the EQ, and if you want to leave runners, you can target the standard deviations above. Let's look at another example. Asia range, high and low. Break through the Asia range, below it. First standard deviation, turtle soup at the standard deviation. Break through the high that broke the low. Important, change in state of delivery. Entry long, targeting where? The equilibrium, the high, or the standard deviations above. Recognize something. Standard deviation, reverse. Standard deviation, retrace. Standard deviation, retrace. Very, very important. That's going to be it for today. Those of you who have stayed to the end of this video, I would like to mention something. I do have a Telegram channel. It is free. It will always be free. The link is in my YouTube channel description, bio, and it is within the description of every single lecture that I have posted. I have not shouted out the Telegram specifically because I wanted to see who were the astute traders, who are the astute students. I have them listed. Everyone else is welcome to join. However, just know you have missed your spot, missed your entry for something big later down the line. I will reward those who were astute, the same way I was awarded. Let's get back to the chart. Study exactly everything that you've learned in this video, backtest everything, and then once you feel comfortable, begin to forward test. With that being said, good luck trading.